You could lose $4,200 a year due to this one Fed move. The Fed's recent meeting minutes reveal a split on interest rates, and it's happening now because inflation is at 6.5%. You'll learn how this impacts your mortgage, credit card debt, and investments, and what you can do about it. The Fed's potential rate hike could increase mortgage rates to 7.5%, costing the average homeowner an extra $420 a month. For example, a $300,000 mortgage in New York City could see payments rise from $1,500 to $1,920. Back in 2008, when the housing market crashed, mortgage rates plummeted to 3.5%, but now they're rising again. This could also lead to a decrease in home prices, which could be beneficial for first-time buyers, such as a young couple in California looking to purchase their first home. Additionally, the rising mortgage rates could lead to an increase in mortgage insurance premiums, which could further increase the cost of homeownership. Furthermore, a family like the Smiths, who are currently paying $2,000 per month on their $400,000 mortgage in Texas, could see their payments rise to $2,600 per month. Moreover, the increase in mortgage rates could also lead to a decrease in housing demand, which could result in a surplus of homes on the market, giving buyers more negotiating power. Next, we'll explore how this affects credit card debt. But the part that surprised me most is what this does to your credit card debt. And it's not just about higher interest rates. You'll learn how this could lead to a decrease in credit limits and an increase in fees, which could have a significant impact on your financial stability. For instance, if you have a credit card balance of $2,000 with an interest rate of 18%, you could see your minimum payment increase by $50 per month. That is next, and it's crucial to understand how to navigate this new landscape, especially since credit card debt can be particularly devastating for those living paycheck to paycheck. You'll discover how to avoid common pitfalls and create a plan to tackle your credit card debt once and for all. The average credit card debt in the U.S. is $4,700, and with the potential rate hike, interest rates on credit cards could rise to 22%. This could cost consumers an extra $870 a year. For instance, a credit card balance of $2,000 with an interest rate of 18% could see interest charges rise to $360 a year. Historically, credit card debt has been a significant burden on households, and this rate hike could exacerbate the issue. Additionally, the rising interest rates could lead to an increase in credit card delinquencies, which could have a negative impact on credit scores. Furthermore, a common misconception is that credit card debt is only a problem for individuals with low credit scores, but in reality, it can affect anyone, regardless of their credit history. For example, consider the case of John, who has an excellent credit score but has accumulated $10,000 in credit card debt due to unexpected medical expenses. The rate hike could increase his interest payments by $1,500 per year, making it even more challenging for him to pay off his debt. Next, we'll explore how this affects investments. But the part that surprised me most is what this does to your investments. And it's not just about the potential losses. You'll learn how this could lead to new opportunities in the market, such as investing in real estate or dividend-paying stocks. For example, if you invest $10,000 in a real estate investment trust, REIT, you could see a return of 8% per year, which could help offset the potential losses in the stock market. That is next, and it's crucial to understand how to navigate this new landscape and come out on top, especially since the right investment strategy can make all the difference in achieving your long-term financial goals. You'll discover how to create a diversified portfolio that can help you weather the storm and thrive in the face of uncertainty. The potential rate hike could lead to a decrease in stock prices, which could be beneficial for long-term investors. For example, a $10,000 investment in the S&P 500 could see a decrease in value to $9,000. However, this could also lead to an increase in bond yields, which could be beneficial for bond investors. Back in 2018, when the Fed last raised interest rates, the stock market experienced a significant correction, but it eventually recovered. Additionally, a second-order effect of the rate hike could be an increase in the value of the US dollar, which could make imports cheaper and potentially lead to lower inflation. Furthermore, a common misconception is that investing in a rising interest rate environment is always bad, but in reality, it can create new opportunities for investors who are willing to take calculated risks. For instance, consider the case of a company like Coca-Cola, which has a strong track record of paying dividends and could benefit from a rising interest rate environment. The company's dividend yield could increase, making it a more attractive investment opportunity for income-seeking investors. Next, we'll explore how to prepare for this change. So, what can you do to prepare for this change? First, consider paying off high-interest debt, such as credit card debt, as soon as possible. Second, consider investing in low-risk investments, such as bonds or dividend-paying stocks. And third, consider working with a financial advisor to create a personalized investment plan. For instance, if you have a $5,000 credit card balance with an interest rate of 20%, you could save $1,000 per year by paying off the balance in full. Additionally, you could consider investing in a tax-advantaged retirement account, such as a 401k or IRA, to reduce your tax liability and increase your retirement savings. Moreover, a historical comparison can be made to the 1980s, when interest rates were high, and investors who were able to adapt and adjust their strategies were able to thrive. For example, consider the case of Warren Buffett, who was able to navigate the high-interest rate environment of the 1980s and come out on top. By taking these steps, you can help protect your finances from the potential rate hike and create a solid foundation for long-term financial success. Furthermore, it's essential to regularly review and adjust your investment portfolio to ensure it remains aligned with your financial goals and risk tolerance. Next, we'll summarize the key takeaways and provide a final call to action. In conclusion, the Fed's potential rate hike could cost you $4,200 a year. To prepare, consider paying off high-interest debt and investing in low-risk investments. Take a specific action today, such as reviewing your budget and identifying areas where you can cut back on expenses, or scheduling a meeting with a financial advisor to discuss your investment strategy. Additionally, make sure to prioritize your financial goals and create a plan to achieve them. For example, you could set a goal to pay off your credit card debt within the next 12 months or to increase your retirement savings by 10% each year. By taking these steps, you can help protect your finances from the potential rate hike and create a solid foundation for long-term financial success. This is for education, not financial advice. Talk to a fiduciary for your situation. If this changed how you think about the Fed's impact on your finances, hit subscribe. I break down one of these every week, and I'll provide you with a free resource guide to help you get started on your financial journey. Take control of your finances today and start building the future